All right, so yeah, I'm Michael Moran, as you've all heard me talk about before, at First National Bank. I'm at the 30th and Iris location. Yes, we are from Omaha, but we are a personal community bank because every single one of our branches is built with a purpose and with the community in mind. Boulder's community is so large now, we have 3 branches here in Boulder area. So we have the 30th and Iris, there's one right here, I don't know the direction very well in this building, Broadway and Canyon. Yeah, that's our Canyon branch. That's a very old branch. And then we have a brand new one on Table Mesa and Foothills Parkway. That used to be a McDonald's and then a coffee shop that both banked with us. And then we gave up and just decided to take the building ourselves when they both went out. So yeah, I've been at this branch here, not since last July, but the July before, because I started, my anniversaries are aligned with the group and with my job. So been with the bank for 2.5 years though. I started off just as a teller and really enjoyed banking. It was a whole new trip for me. I was a retail manager for years prior to that and decided to try something new. So started my career over basically. And when I first started as a teller, immediately decided I want to be a banker. That is exactly what I want to do. It's math, it's talking to people, it's having my own office and pretending to be important, which are all things that I enjoy. So I eventually took a position at the Irish branch and ended up in Boulder. And then I was trained by everybody's friend Megan. She trained me on everything that I know. So if I say anything that isn't accurate, it's her fault. One of my big focuses is home equity. Colorado is a very unique state in the fact that you gain equity by just existing. You can have an equitable home with lots of extra value in it in a year. Most places, home values are flat and some places decrease on you. But Colorado is a pretty good place to have a home. It's a great investment. So how do you make that investment go further is by tapping into that home equity. Now we do lots of talk in here about what the ideal client is for us, and what, for me, we'll look at what makes someone a potential borrower for me. So what kind of person is a good option for a home equity line or loan, and it's literally anyone with a home. Anybody who has a home can be qualified to have a home equity product on it. You don't need to have an immediate need to have a home equity product. It's not like you're in a bind and you need money. It could be future planning, it could be an emergency fund, or it could be a project that doesn't necessarily have a specific due date or end date. At First National, for just $250 for an origination fee, you can have a line or a loan placed into your property for between $10,000 and $150,000. That's a pretty good chunk of money up front for only $250. You can even just finance that right into the loan. There's some fixed rates on, our loans are fixed rates, our lines have variable rates, but we have promos going on to make it a little bit more cost effective for you up front. If you do need to go above that 150 mark there, we can go up to $249,000, and then all you have to do is pay for the appraisal, which in Boulder your appraisal will be $600 to $800, somewhere in that range, unless you're living in a $3 million home, then maybe charge a little more. So yeah, specific large purchase in the future is more of a loan conversation. And it's also, I threw that in at the last minute, we can do them not only on your primary, but on rental properties as well. So there are people who will go out, buy a rental property, need to do a little bit of work on it to fix it up, take an equity loan against the rental property itself to keep all their finances separate. Those rates aren't usually as good though. So yeah, there are more than one option that you can go on here. There's 2 ways to tap into the equity, technically 3 with bridge loans, but that's not something that I really delve into too much. But lines of credits or fixed loans with your equity. So this is a monster mash slide, and the line versus loan here. So a home equity line is a revolving reusable line. So basically what you do is you take the extra value in your home, so your home is worth a certain amount of money, you've paid off a little bit of it, if the value has increased, that little area there, you can take out a line of credit using that as collateral. It's great for a project without end or just an unclear budget. So if you decided, I'm going to build a deck, and somebody asks you how much is it going to cost, you say, I don't know. This is a great option because then you max out the line at $100,000. That's going to be an expensive deck, but if you max out your line, you can pay it down and then reborrow again. So it's not a fixed loan. It can also be used for emergencies. So one thing I like to talk about a lot is specific clients, people who are planning on retiring soon. It's an ideal situation, true, but I do get a few clients who are saying, hey, I'm going to retire in the next few years and my house is paid off. Perfect. You have tons of equity in your home then, it's paid off. You can have this line for $150,000 for an emergency. Most people who are retiring, $150,000 is plenty for them to survive off of for just a little bit until they can get things sorted out. With home equity, you have a 10-year draw period. You can have a promo rate for some of that draw period there. After that 10 years, it gets fixed into a loan. So what a home equity loan is it's one lump sum up front, and then it's great for specific goals, like if you're doing a big debt consolidation, or if you have a specific dollar amount for something that you need to do. Then you can have a specific dollar assigned to you, a fixed term, fixed rate with fixed payments, and you can spread those costs out over 15 years, which can drive your payments down significantly. So you get a lot of people coming in with big credit card debt or big auto and personal loan debt, and we can just roll it all together, use the home to secure it, drive your payments from paying $700 to 5 different institutions to paying maybe $1,000 to just us. Now granted, it's going to take a little bit longer to pay it off, but you're going to be saving so much money every month. We don't have any sort of prepayment penalties on it. Just pay it off a little bit early, refinance it later down the road, and you can save a ton of money. So my last slide on here is just some basic rates. This isn't everything that we have for rates. This is just the most popular. I do have a full list of rates, and then you guys can always call me or stop by the branch and find me and ask me more questions. But over here are the HELOC promo rates. So that's the important one. So with that line of credit for the first 12 months, you would have only 2.49% interest charged to anything that is on the line. Another great thing about the HELOC promo rates is, or the HELOC itself, is most of the time you qualify for interest-only payments. So all you have to do, if you borrow a ton of money, you just pay 2.49% interest rate. That's all you have to do. You don't have to touch the principal. Granted, you want to pay that down eventually. Or swap over to a home equity loan. And then with home equity loans, it depends on how much value you have left in the home and how high we can go. These rates tend to be a little bit higher, but most rates in banks are based off of Wall Street Prime, so it's a variable rate. And right now, Prime is up at 5.25, which means right here, you're going to be matched at Wall Street Prime, and with a margin above, you'd be higher, and it's going to keep going up. So getting fixed into this 6.75 right now sounds like you're missing out on 0.5%, or no, a whole percent there. But in the long term, you're going to be saving money. Once you hit the end of that 120 months, who knows where interest rates can be then. So, any questions or anything about the equity portion of this presentation? Just kind of leave it there on interest rates.
So if you want a $150,000 loan, it's $250 and no appraisal if you have.
Right. So if it's under 150,000, it's not relatively not that much money. So the bank is more comfortable just doing, an internal appraisal where we just take comps in the neighborhood and things like that. Okay. So your $250 actually pays for the processing fee and then that quick appraisal instead. So yeah, under 150 for a line or a loan.
And you will not go over 250?
No. So if something happened and it turns out that your property is unique, which does happen in Boulder area so often, it will comp the appraisal if we have to do a full appraisal. Okay. The downside to that is it does delay when you have your funds available to you, because then you have to schedule time to meet with an appraiser to go out to your home.
But you said, what's the max home equity line you guys get?
The maximum, the highest that we can go is 500,000. which I didn't mention that in here because it's not very common to go over 249.
Yeah.
So once you reach the 249 mark, you have to pay for the full appraisal. Then you also have to pay for what's called title insurance. Title insurance is insurance provided to ensure that there's no errors on your titling and deed. Boulder is old enough that that actually does come up sometimes, where somebody will dispute and say that part of your property belongs to you. So the title insurance is there to protect the bank and yourself.
So how do you figure your income for self-employed individuals?
Very, very carefully, and I make a lot of good statements about your personality, actually. The bank does a lot of manual reviews on this sort of stuff. So if you are self-employed, most likely you have some sort of reporting that you do on taxes. You have to record it somewhere, usually, not everybody. However you record, yeah, I'm looking at you like, they try to record it, right? Usually just bringing in tax returns. If you have an LLC and then you're the sole owner of it, you'll have your business taxes and your taxes. If you're a sole proprietorship, then your business taxes and your personal taxes are usually together. And then either way, 2 years worth of tax returns, I can prove anything usually with our underwriting team.
So the 10-year thing on the HELOC. So let's say, you know, I take out $150 or whatever in the first year or whatever. It gets paid off, obviously, and then it doesn't get used for the next 10 years. Does it just vanish, or?
Nope. It just sits there for 10 years not being used. No annual fees or anything associated with it. So after you've done your project, if you have a home equity line of credit, then you have that whole line for emergencies in the future. So it could be multiple purpose. Now it will expire on the promo rate. That's where you'll want to make sure, come back and talk to me if you're ever going to tap into it and it's 5 years down the road, because your interest rate might be super inflated all of a sudden. You owe nothing, but there's a huge interest rate. So you'll want to take care of that before you go and dump a ton of money onto it.
But at the end of the 10 years, it just goes away.
Yep.
Pretty much.
So at the end of the 10 years, if you have any balance at all on it, that chunk gets parsed out over a 20-year period. You have a 20-year repayment plan on it.
Okay.
But if there's nothing, then it just closes.
At the end of that, you got $50 and it goes out for.
Yeah, I've had to amortize like $200 over
Right.
20 years. And say, here's your repayment plan in the next 20 years, or you can just come in and cut me a check and I'll spend it. Period, because that's ridiculous. Yeah, so anything else, guys? I did touch on it briefly. It does count for rental properties as well, which is a big thing in Boulder. Interest is not as good on a rental property, but it is a good option if you need to do a quick turnaround or if you need emergency funds. Yeah.
Define not as good.
So not as good meaning you immediately jump into a variable rate, which means that you have a margin above what Wall Street Prime is at. With the promo rates, 2.49 is well below, even the 4.99 is well below your Wall Street Prime and your margin. So right now, 5.25, I think the starting point would be 7.5 or 7.75 on a rental property.
Because the promo rate doesn't apply.
Because the promo rate does not apply, and the margin is a little bit bigger on a promo than it is on a personal. Again, you only owe money on what you borrow. So if it's there for an emergency, it's great. If you have an actual project to do, I'd be looking into a home equity loan instead on a rental property, because that fixed rate will make it worth it in the long run. Might have to pay a little bit more up front, but you'll save a ton of money later on.
Thank you so much, Michael. That was awesome. And yeah, let's